Democrats and Republicans are at odds over an analysis of the Senate tax bill that found that low-income taxpayers would receive a tax increase under the plan. Republicans called it misleading, saying that the increases reflect tax credits that would no longer be claimed because of the repeal of the Affordable Care Act's individual mandate, the requirement to buy health insurance. Congress's Joint Committee on Taxation, which published the report, released a separate analysis that does not include the effects of the repeal. Here is the difference between the estimates for households that make from $10,000 to $20,000. Average tax rates for the $10,000-$20,000 income group. The initial analysis found a tax increase for low-income groups. The second took out the effects of the individual mandate repeal. Senate bill without repeal affects average tax rates for the $10,000-$20,000 income group. The initial analysis found a tax increase for low-income groups. The second took out the effects of the individual mandate repeal. Senate bill without repeal affects. The reason that estimated tax rates are higher when the repeal is considered is because without a requirement to purchase health insurance, many would choose not to buy coverage. As a result, those without insurance would forego the federal tax credits available to subsidize their insurance premiums. Republicans, and some tax experts, say the choice to not take a tax credit is not an increase in tax burden and therefore should not be considered a tax increase. Without the effects of the ACA changes, average tax rates would initially fall for all income groups under the Senate plan. But the individual tax cuts are temporary, expiring at the end of 2025 in order to keep the plan within budget limits under Senate rules. Corporate tax cuts in the bill do not expire, which explains the differences after 2025. Average tax rates under current law versus the Senate tax plan. Senate bill with effects of mandate repeal. 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 Even if analysis that includes the effects of the individual mandate repeal overstates the tax increase that low-income people would face, it leaves out other consequences of the repeal. The Congressional Budget Office projects that premiums would rise by 10% for most years over the next decade, and some middle-income households who do not qualify for premium subsidies would drop their plans because they would no longer be able to afford insurance. Source: Joint Committee on Taxation.